Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future today. Josh, we're going to be talking about life insurance.
That's right, in case my breakfast cereal gets stale or I lose pieces to my favorite board game.
Not life cereal insurance or life board game insurance, but insurance to cover needs should you or a loved one unexpectedly die.
Okay, so this is one of those really exciting, we love talking about. It's the favorite thing in the world.
Everyone wants to talk about it.
Oh,
no, in fact, this is probably the least sexy. Did I just use sexy and life insurance in the same?
For podcasting.
This is the least. Yeah, it's the least attractive, exciting topic, but it's actually very important.
Yeah, and that's one of the things as a financial planner. It's one of those subjects when we talk about estate planning in general. When we talk about end of life, and you force people to think about that situation. It's hard.
Yeah,
they don't want to do it. People put it off, and so these are some of those things that people will tend to put off. When it is really important, like you said.
So, Josh, let's stop.
Yes.
And not start. No, we're going to start. We're not going to stop.
Stop and start.
We're going to start like we always do. 50,000 feet. We're in a Boeing 777.
Yep. And you have life insurance.
You have life insurance because the one engine just went out? That just happened.
It did.
That's current news. So, yes, 50,000 feet. What is life insurance, Josh?
Yes. So, life insurance in general, is you passing the risk from yourself to someone else, usually a company. And so in this case, life insurance, you're passing the burden of some sort of monetary cost of when you pass to a company. And in exchange, they want you to pay them monthly or annually for that risk.
Yep.
So it's the same if you think of car insurance. You could have a big car cost. If you crash your car, to replace it, it'll cost tens of thousands of dollars probably. That's a big risk. You pass that risk on to an insurance company by getting car insurance. So you pay a monthly premium, and the car insurance is betting if they insure enough people that they're going to collect more money in any given time frame than the money they have to pay out.
Right, that's how insurance companies.
That's insurance
all
in general.
insurance
All
companies
across the
make
board.
money that way.
Right.
They receive more in premiums than they pay out.
Yep, and they can invest that money while they're waiting.
Exactly.
So if you buy, and we're going to get down to this, but if you buy some sort of whole life insurance product or a continual insurance product, anything that lasts for not given a given set of time, they're guaranteed at some point they're going to have to pay out. So then their table and their bet is on, can I collect enough money and earn on that money to offset what I pay out at the end?
Right.
And so insurance, life insurance is just saying, okay, if something were to happen to me early, I have obligations, whether it's debt, whether it's future payments for kids, ongoing living expenses, whatever it is, there's money that is going to be needed that I can no longer provide. I'm no longer here. So I will pay monthly this insurance company for the guarantee that they will pay a lump sum if something were to happen to me. So that's what, from a high level, that's what insurance is.
So let's talk about the parties that are involved. So start with you.
Yes, so a policy holder.
That's generally you.
This is a person who owns and pays the insurance premiums. Now, they're the only person that can make changes to this. So the policy holder is the one that pays to keep this insurance policy intact, all right? They own it. Now, they could be the person that it's insured on, meaning if something happens to me and I have the policy, then that triggers the event. The insured person is whose person the death causes the payout to happen.
So you could have an insurance policy on your wife.
Yes.
So then you're the policy holder, but she's the insured.
Right. And we're going to talk about that in a minute. And then the third person is the beneficiary, is who gets the money if something would happen to the insured person.
Right.
All right. So there's really three people involved. It could be one person has everything. One person could be two of those. It could be three separate people. And we'll talk about why and how that works. But in general, there's someone who pays the premiums to keep it active, and they own it. There's someone whose life it's being monitored for the death to trigger it. And then there's a person who receives the money at that death.
It does seem unlikely that you would be the beneficiary and the insured.
Yes, unless you have it paid to your estate.
That
would be where you would do that. You'd have your estate
I'm trying
receive
to make a
it.
joke.
Right. But there are people that do that. The problem with that then is once it's in your state, it becomes taxable. Now, we'll get into that down the road, but high level, you could be all three. More often than not, you're two of the three. You're the policyholder and the insured, and then you name a beneficiary for that.
Right. So kind of go a little bit deeper into who.
Yes.
So you talked about the three categories of people, but who specifically, who can get insurance?
Anybody can get life insurance. Now, who can you get it on is the question.
Right.
Right? And so you got to be an adult, all right, for one, to get the life insurance. Now, you can get it on a minor.
Right.
But
in fact, that's not uncommon.
not uncommon. But you can get life insurance on anyone who you're deemed to have an insurable interest in. Another way of saying that is, I have a financial interest in them, or if something were to happen to them, my finances would be affected. So, great example of that you used is spouses.
Mm-hmm.
So, if myself and my wife, we both have jobs, we both work, if something were to happen to me, our income would be cut in half, right, between the two of us.
Right.
Whether it's proportional, it doesn't matter. But we would lose some income within the family.
Yep.
So my wife has an insurable interest in me in that she would be financially impacted by my death. So she could get a policy on me. Now, you can extend it up and down, so parents and grandparents, we'll talk about those. In order to do that, though, if you're getting an insurance policy on somebody else, you have to have some criteria to fit in. Now, if you're getting on yourself, this criteria is automatically kind of enacted, right? You have an insurable interest in yourself, right? If you die, there will be a financial impact. But second, if you're getting on someone else, they have to give permission. And they do that by a couple things. One, they actually have to sign the policy.
Right.
They have to be aware that someone's getting insurance on them. And second, they have to go through, if required, medical screening. So they have to consent to that. You can't just have to, go up and start drawing their blood, right? They have to consent to that. And so signing the policy and going through the screening is them giving that permission to be insured, to be the person that insured is on. And so, again, going back to spouses, you'd have a conversation. Usually, I would get my own insurance but make my wife the beneficiary, so then you don't have to worry about that consent because the insurance policy is me and I'm the policyholder.
Exactly.
I'll pay my own premiums, and then maybe my wife does the same. You mentioned the kids.
Yep.
So nowadays, they have riders on your own insurance policy where you can just add a rider to your own insurance that says if there's an untimely death of your kid who's a minor, they'll pay. So you're not really getting your own insurance policy on them. It's kind of a workaround because more often than not, you don't have a financial interest in your kid, right? Their untimely death, as tragic as that is, does not impact you financially. But you do get the burden of paying their funeral expenses. So that's what the riders
And those
really
riders
look for.
are often pretty small, $10,000, $20,000, something like that, just to offset those expenses.
The average cost is just under $10,000 for a funeral. And so if you get a $10,000 insurance policy, you get that
super
money.
cheap.
You can help cover the expenses.
Yeah.
And so that's what it's there for. But here's some examples, though, of where you would get an insurance policy on someone else. So again, remember, you're getting the policy, you're the policyholder, so you're responsible for paying the premiums, not them. This is why you do that. One, business partners. So if there's a business and you have a partner, if something were to happen to them, that would probably impact your business. Now, you can get cross life insurance and all these different things, but one thing you could do is just take a policy out on them. You pay the premiums yourself, and if something were happening to them, you would get a lump sum, and then you could continue the business on.
Really, it'd probably be the amount to buy them out.
Yeah, really, to buy them out, or you get each other's
Yep.
insurance. But in general, you could do that, and you would have an insurable interest.
And they would probably think of doing the same thing for you.
You would encourage that.
And then you would be covered no matter what happens.
Another one would be parents. And so if you're an adult child and maybe you're the caretaker of the parents, or maybe your sibling is a caretaker of the parents, having an insurable interest would be, what if, let's say it's me and my sibling, and I live out of state and my sibling lives in state with my parents and she's taking care of them, or he. If something were to happen to my sibling, my parents now are in trouble. And so burden would be on me to take care of them. I could get an insurance on my sibling to then give a lump sum to help take care of my parents. That's an example.
Yeah.
You probably encourage your parents to do that, but if they can't afford it, because remember, the policyholder has to pay premiums,
Exactly.
maybe it falls on me. Another one you see a lot of is former spouses. So if you go through a divorce and there's kids involved, sometimes the court may actually order one of the spouses to carry insurance
Gotcha.
if they're the one that requires to pay alimony or child support. But if they don't, and you're still worried about that, you could get a policy on them because you do have a insurable interest, even though you're no longer married to them. there is a financial interest in that person to continue to pay alimony or child support, that you could pay your own premiums for that insurance policy on your ex-spouse. There's no burden on them besides consenting to the initial screening.
Yeah.
But after that, they aren't responsible for premiums. It's not out of their pocket. It's for you in case something happens to them.
Right.
So you actually do see that quite often.
Yeah.
If the court doesn't order it, a lot of times the spouse will do that on their own. And then another one would be if you're a parent and you have an adult child. Again, if they're moved out of your house, there's probably no financial interest except if you co-signed a loan with them. So going through college, sometimes you have to get out loans, and a lot of times the parents will co-sign that loan.
Yep.
If something happens to the kid, that loan doesn't go away.
Oh, yeah.
It's co-signed person is responsible for it.
And this brings up a whole nother topic for another day,
Right.
but if at all possible, I understand educational expenses, sometimes take certain priority, but if at all possible, it's generally thought of as best to avoid that if possible.
Yes.
Co-signing loans for your adult children
Co-signing-
can be risky.
Co-signing any loans, whether it's education or
Yeah.
anything, assume you're paying the full amount.
Yeah.
If you're going to co-sign a loan, just make the assumption I'm responsible for this full amount, and just assume that.
So don't do it.
Don't do it.
Just don't do it.
Yeah. But overall, those are just some examples of where you get an insurance policy on somebody else. Because a lot of times you might ask, why in the world would I do that?
Right.
But those are some examples. But more often than not, going forward, we're kind of just talking about, generally speaking, most people get a life insurance policy on themselves with a beneficiary of either a person or a charity or some sort of entity.
Yep.
All right. So that's kind of what we're talking going forward.
So break it down, Josh. Who needs life
Yes.
insurance?
So it's one of those, again, depends is what I say a lot of times. And it's true.
Typical Josh answer.
Yep. High level, though, again, if someone relies on you for financial support or income, then you probably need insurance. If you have obligations, maybe no one's relying on you, but you're going to have debt post your passing, then you probably should have some insurance to not burden someone else with that debt,
Right.
because it's got to go somewhere. And so those are the main reasons. A third one, and it can get complicated, so I don't want to go too deep from a podcast standpoint, but if you're in the spot where you're going to possibly see estate tax, you can use insurance vehicles potentially to reduce your estate tax, move some assets out of your estate, and give them to other people. An example of that is Irrevocable Life Insurance Trust, or ILIT, I-L-I-T. It's just the
Fun
abbreviation
acronym.
for it.
Yeah.
Pretty much, it's an irrevocable trust, and if you've heard us talk about trust before, irrevocable means you cannot change it. It's set. Once you do that, it's done. So what you do is you put a life insurance policy in this irrevocable trust. It's no longer yours because you do not have control anymore. Whoever you say is beneficiaries is set. You cannot change that. Now, you sign a trustee there, and the trustee's job just to make sure the premiums are paid and stuff. You do that, you can get that asset out of your estate, because life insurance paid to any kind of life insurance you own is part of your estate.
Right.
And so it can be taxable. So moving some of those things out can help avoid it. Again, it's very complicated. There's rules such as it has to be in effect for 3 years or else it doesn't even count. You have to pay premiums. Well, since you no longer own it, you can't personally pay premiums anymore. The trust has to pay it. So you have to gift money to the trust every year. But then there's a thing called the crummy letter, which means every beneficiary has the right to grab that money every gift you make.
Oh, my.
But you want to encourage them not to, because
Right.
you want to pay the premiums. Because if they take all the money, you can't pay premiums. That insurance inside the trust becomes default, and then there's no benefit anymore. So there's all these fun stuff. Talk to an attorney or a financial professional.
That's just it.
But in general, just so people know, there are some life insurance products that can help you move some money out of your estate. You can also gift life insurance to other people, removes it from your estate. There's certain rules on that with gift tax as well. But in general, it's something you can do.
This is one way that lawyers make their money, because the rules are very complicated, and
Rules are
they help
complicated.
people navigate these complicated rules. So,
Yep.
yeah, well, I mean, I think we'll probably have an episode at some point about wills and trusts
Mm-hmm.
and all of that in general. But yes, this is a very important part of that. So, Josh, let's take a break.
Yes.
This is obviously a little bit sad, thinking about death.
Yeah.
So I'm going to try and lighten up your mood a little bit. Josh, this is more of an open-ended question for a dad joke. Would Transformers get life insurance or car insurance?
Oh, man. That's a good question. I don't know.
Flesh that out.
Yeah.
What are your thoughts?
I would feel like the Decepticons wouldn't have any insurance, and they would just be like walking around.
They're like rebels.
uninsured and just causing
Causing
burden on
mayhem.
everybody.
Yeah.
Yeah. Man, that's a good question. I mean, if they have the Allspark, they would probably need life insurance because that makes them living entities.
Okay, there you go.
Because I'm a dork.
Yeah,
I know that
you actually know that stuff. Okay, so
That's funny, though. I like it.
let's get back. Let's break down a couple different types of insurance. So what are, the most two common types of life insurance specifically?
Yep. So there is whole life insurance, or what's called permanent insurance.
Yep.
And term insurance.
Yes.
Term being a set amount of time. And so that's, from a high level, that's two different types. Permanent, meaning it's always there until death. Term, meaning we set a time frame and it's there in effect until that time frame ends, or you die within there.
So break down. Let's start with whole life.
Okay. So whole life insurance gives you a premium that you pay, and every time you pay the premium, a portion goes to cover the insurance costs. A portion goes into what they call a cash value bucket, which is for if you have whole life, it's usually a set fixed interest rate that it grows by. You can borrow against and withdraw that amount in the future as it grows. They have kind of thresholds that you can do with it, but it's kind of an additional piece to insurance. And so you have your death benefit. Let's say it's $100,000. And then on top of the $100,000, every premium, you would then get a portion that would go into this cash value bucket. And then over time, you may have $5,000 in this cash value that's yours to use for whatever. And it grows at a set interest rate. Then there's within this whole life things like universal life and variable, where instead of a fixed interest rate, you have it tied to maybe the SP 500 and it tracks the movement that way, or some sort of variation there. And so that's what, and universal also has the caveat that you can adjust your death benefit up and down as well. So you could get to the point in a whole life policy where your cash value is big enough where you can use that money to pay your premiums, and you no longer have to pay into it for a set amount of time. The premiums of the cash value cover it, and you still have your death benefit. Now, historically speaking, you pay more for that type of insurance policy for a couple reasons. One, it accrues cash value, and two, it's not a set time period. So they're on the hook a lot longer to pay out, meaning they have a higher probability they're paying out.
Right.
And so they charge more for it.
So I think historically speaking, however, the returns that if you view that as a growing vehicle because of your cash value bucket, the returns are typically not stock market quality.
No, it's tied to it, and so you may get a percentage or something.
But it's not going to be. Yeah, you're not going to get.
You're not going to get the full amount. There's costs associated with it.
Yep.
Now, I will say, here a lot of fee-only advisors, which is what we are, we're not big proponents of whole life or universal life because of the added costs on that investment side of things.
Yep.
But it does force people to save. So the one side of it is if you struggle with putting some money aside, knowing you need insurance and you're going to pay those premiums, it can force people to save and accrue some cash value for emergencies and stuff. Now, I'm not a huge fan of it. I think you should do insurance for insurance and investing for investing. But for some people, especially if they don't have an advisor helping them, it does force savings in a bucket. Now, the flip side, term insurance is a set premium for a set amount of time with a guaranteed death benefit.
Right.
So you could get a 20-year term, meaning for 20 years, as long as you pay the premium, if you die within that 20-year period, they will pay that death benefit. It does not accrue any value. Your total premium goes towards that insurance company's risk they're taking. It's cheaper. It's the cheapest way of getting insurance. In my opinion, it's the best way to go, especially for young people, because a lot of times you don't have a lot of money.
And healthy people.
They're on young, healthy people, because you're just covering the risk, the what if, right?
Exactly.
That's really what it's there for. So, again, shop around, but you'll find more than likely term insurance is the cheapest, most affordable way to get the highest amount of coverage.
So that is term versus whole life. So I guess the bigger question probably is specifically, let's maybe specifically focus on the term side of things.
Yes.
I think it makes a little bit more sense to head the discussion that way. But how much life insurance do you need?
Yeah, 10,000. No, there's not a dollar
or $1 million or 10 million or who knows?
The dollar amount's not as important as what are my obligations and what are my future goals that I'll no longer be able to contribute towards. So if I'm a family with kids and we had anticipated both of us working until we're 60 years old and then retiring and then helping to pay for college in that in between time, those are some goals that will be drastically disrupted if one of us were to die early. And so you would then say, okay, let's say I have 2 kids and I want to pay for college for both of them, and it's going to be $20,000 a year for college. So then you say, okay, you could run a calculation. Your financial advisor could help you with that. But you'd in a sense say, what is that? If I had a lump sum of money, how much would I need to cover all those college goals? So then that would be a piece. You say, okay, what if I died when I was 30, but we didn't think we'd be able to retire until 60? That time frame from 30 to 60, that 30-year difference, I'm going to need some sort of money to get us there. And so what's that lump sum? So you're really just saying, what are my future needs, and bringing it to today and saying, how much, if I had a lump sum, would I be able to take care of all that? And that's where you get your how much from. And so, when you have, let's say you have a couple and one is working, one's staying from home. Well, the working person, you need to offset that income you'd lose. The stay-at-home person, you need to offset all the things that they do that allow the other person to work. So if you have kids at home and they're the primary provider of that, I'm going to have to hire someone to take care of the kids or find daycare or something, which is not cheap. And so either spouse would need insurance on them, not just the working spouse, because there is intangible benefits that the stay-at-home spouse provides that cost a lot of money if needed to be fulfilled elsewhere. And so the answer is how much do I need to make sure that those remaining can still reach the goals we are trying to do together?
So I want to put a couple morbid notes out there. So this is sad, this is morbid, but these are things that probably should be discussed. First of all, it occasionally has happened through history where a beneficiary, so typically a spouse, will kill the person with the policy to get the life insurance policy. This is a real thing that happens. And usually it gets caught and no one gets paid out, and it's very bad for everyone.
Yeah, the insurance policy will not pay out if you cause the untimely death of the person that you were the beneficiary.
Yes, and secondary, it is also, generally speaking, in most policies that suicide does not pay out a policy.
If you cause your own death through suicide, most of the time they won't pay out. The other side too is if you get an insurance policy on someone without their knowledge, or you fraudulently, that's fraud, and you could be prosecuted and you won't receive any benefits. So you just make sure you're on the up and up with all this.
Use it for what it's there for. Exactly. And there's no forcing life insurance to occur. We don't want that. No. Okay, so here's the discussion. And we kind of hit on it before, but I think we should delve into it a little bit more. Should insurance be considered an investment? Should, not is, should.
Now, from a cost standpoint, what you get out of a universal or whole life, minus the fees, minus all that, minus their kind of top-end cutoff points and all the stuff that they do, usually you do not get good bang for your buck. And so insurance is there to cover the what if and to remove the risk from you to someone else.
Right.
So I don't think you should use insurance for an investment.
Generally speaking, if you want to have investments that grow, do that separately for investments to grow. They work together, insurance and investments, for your total financial picture. But let your insurance be exactly what you said. It's insurance. Let your investments be set up to be investments. Yeah. So I've heard of the term, and I think Dave Ramsey's kind of a proponent of this, self-insured.
Yeah. So that's where you start your own company. You call it
Josh Insurance.
MyFlack instead of Aflac. No, self-insured is where you have enough assets saved where you can fulfill all your goals and needs. So in a sense, at retirement, you are self-insured from a life insurance standpoint in that you've already had enough assets planned out to last the rest of your life. And so insurance becomes less of a need. Now, I do know people that carry insurance in retirement, and a lot of times it is that type of $10,000 policy, $20,000, where they say, you know what, I don't want whoever, maybe my kids or whoever, the funeral expenses stuff. I just want them to have quick, because that's the other thing about life insurance. It pays out pretty quick.
Yeah.
When you have the beneficiary, they're pretty timely in that payout. You could get your insurance money and help cover the expenses. So it doesn't mean you can't carry insurance, but at that point, insurance is no longer needed as a replacement for anything because you had everything you need.
An alternative that some retirees may hold insurance for is if they have a mortgage still in retirement and they want to leave as much of their nest egg untouched, if they were to pass. So then they could take out a policy to offset whatever debt they've got. Say they have $100,000 left on their mortgage. Covered, no problem. Then the whole nest egg then goes to the beneficiaries from there.
Right.
But so the goal is to get to the self-insured status, right? We should all be working towards the point where we don't need life insurance, where we have enough saved up so that if something were to happen, our families would be fine either way.
Yep.
It's a process to get there, and that's why life insurance is there, to cover you in the middle.
In-between, yep.
Right? So, yeah, that should be the goal. So, Josh, a new term that
along with that, so to get to self-insured, and we talked about term insurance, sometimes you can layer it.
Yeah.
And so when you're young, you're going to need more insurance, but as you work towards retirement, you need less and less. So you can layer policies. You can have more than one insurance policy, and you may get a 30-year and then a 20-year and a 10-year, but they may overlap. So at the beginning, you have the 30 to 2010 paying out.
Yep.
If something were happening to you the first 10 years. When that 10-year goes away, you don't renew it, you don't get a new one. Now you have the 30 and the 20 left. And then after the 20 years, then you have just the 30 left. And over that 30-year time frame, you went from a lot of insurance to less insurance, and you got your premiums less as you needed less insurance. Yep. And so you can, in a sense, layer insurance on top of each other to provide the amount you need at any point in time in your life.
And that's a really good point, because as you work and as you save and as you become more mature in your financial situation, typically your assets are going to grow.
Yep.
So you'll have more of that already saved up, and you're going to need, so like if you have $1 million policy and you get it in your 20s, and then for 30 years, it's going to expire in your 50s. Okay, great. Well, at the end of that, you're going to be probably way overinsured, potentially. Yep. It depends on your lifestyle, but you could be way overinsured, which is, you're locking in that rate in your 20s, right. So it's pretty low, but still. Mm-hmm. If you do the hybrid life insurance where you kind of layer it on top and you can work that down, you can only have what you need when you need it.
Yep.
So, yeah, that's a great discussion. Josh, any final thoughts on life insurance?
Yeah. So with today's everything going on, long-term care is another type of insurance for long-term care facilities. They have new things like for hybrid life insurance, where they may say, here's a life insurance policy with a rider attached that's long-term care insurance. And then you can borrow from your death benefit to pay for nursing home care before you die. And it's a way of kind of covering both, but not having much out of pocket for that long-term care. So again, if you had a $100,000 life insurance policy, but before you pass away, you're in the nursing home for a year, you could borrow against that using this hybrid policy and say, okay, at my death, now I only get $75,000 because I used $25,000 or whatever it is. But the idea is you could kind of cover both, because there's two different types of insurance, but the policies that the insurance companies that are writing these understand that, they kind of go hand in hand. And if you can get a premium for both, they're spreading their risk out, because maybe you don't use the one, but you have the other, that type of thing. So that it's out there, just something to pay attention to. And I think it's probably worth noting that we've barely scratched the surface on life insurance. Yes. This is very high level in general. So, if you have any questions, don't hesitate to reach out. We'd be happy to talk to you, but mostly, talk to someone who is an expert in specific that field. They'll have some really good questions or good answers for you on that. And as always, check out our free gift to you. It's a brief list of 8 principles of timeless investing. They're overarching investment themes and to keep you on track to meet your long-term goals. We don't specifically mention life insurance in that, but we do note that it should probably be a part of your financial picture. So check that out. It's free on our website. Josh, how can people help us grow this podcast? Yeah, make sure you subscribe. Every Thursday, you'll get an alert or the download automatically into your podcast app, whatever you use. If you're on Apple Podcasts, make sure you like us and review us. That way, more people can find us. Send us any emails if you have a question about life insurance or you have another topic you want us to talk about. Send us an email at hello@theinvesteddads.com. And also check out our website, theinvesteddads.com. That's where you can get the free gift, and there's some more cool stuff on there, old podcasts. And then also, if you know somebody talking about insurance, share this episode with them. All right. Well, until next Thursday, have a good week. All right. Talk to you later. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.